All right, class, moving on. The train is leaving the chapter 14 station. We're heading into chapter 15. If you are not caught up now, you need to get caught up because we'll have exam 1 on chapters 13, 14, and 15, plus time value money from chapter 6. So let's talk about leases. Companies don't always own property. They lease their property. Prior to recently, a lot of companies did this because leases were not required to be put on the balance sheet as an obligation, and yet they had big leases out there. But even now that leases are now going to be on a balance sheet, I think a lot of times companies, a lot of different reasons companies would lease. So I'll start here with Lennox. 2 types of leases. One, I think Lennox had, when I left there, about 250 what's called Parts Plus stores. And they're not open to consumers, they're only open to dealers. And they put these in, Lennox put these in various parts of the country to make it easy for HVAC dealers to come in there in the morning, get whatever products they need to go out to consumers' home that afternoon. It really helped expand revenues for Lennox. It was a big part of Lennox's win. But the point I want to note here, these leases were only 3-year leases. And so at the end of 3 years, we say, hey, that location, let's move to a different location. So there's a very small obligation. They didn't really have anything related to kind of owning these properties. They would move in a heartbeat after 3 years, and they're always examining locations. Now, the property they were leasing, and you can look at this here, it looks like pretty nice property. So that, what we call the lessor, the person leasing this who owns that property, they got to find a new tenant. And so they're out there, and the life of that property is probably 30 or 40 years. We're only taking, in Lennox, a little 3-year piece of it. And so, by the way, we're going to call these kind of leases operating leases. There's no kind of form of ownership here. We have a right to use these properties for only 3 years, a small piece of their total life, small piece of their total value. Let's contrast this to the Lennox headquarters, and this was what was called in the past, fully disclosed, a synthetic lease. And I won't get into all the details of this. I'll give you some piece of ownership, piece of discussion here. Lennox is never on this building. This building was built for them, and a consortium of banks paid all the money for this building, designed exactly like we wanted it, fully use it. And at the end of this lease, though, even though Lennox has never owned it, they guarantee the value of this lease at the end. And so if they want to leave the property and the property has a fair value of less than X amount, is in the like $40 million range, then Lennox had to make up the difference. So, boy, that sounds really interesting. That is unlike the Parts Plus locations. It feels more like Lennox is an owner of this, even though they're just leasing it. Now, under the former rules, Lennox was able to meet the complicated criteria around a synthetic lease, and this obligation was not on their books as an asset or a liability. Yet, it seemed kind of funny to me because Lennox has been there, I want to say 14, 15 years, because when that synthetic lease in, they created another term of 7 years. And so doesn't look to me like Lennox has any desire or thought to get out of that. And if they wanted to, and the property value declined, they would have to make that up. So it feels much more like Lennox owns this property, even though they're just leasing it. And so the rules changed in 2018's first time 2019, that companies had to put leases on their books, all leases, as a liability and an asset, right to use asset. So that's what this chapter is about. And so the lessor, that's the person who owns the asset, the property, and the lessee is a person that's using the asset, and they're providing cash payments back to the lessor. And so advantages of leasing provides, flexibility is a big one, facilitates operational incentives, tax advantage, effective security prices, but I get back to the flexibility point, especially like in the Parts Plus locations, where they could move those if they wanted to. So a lot of flexibility there. And so we're going to look at we ourselves as accountants, not leasing experts, we are going to classify leases into two types. One is, let's go to the bottom one, operating lease. They're just normal operating leases. That would be much more like the Parts Plus stores I showed you. They're short-term. There's nothing in any semblance of real ownership here around this lease. And we have some criteria to kind of drive us, to help us evaluate, is it more like an ownership situation in a debt situation, or is it more like just general renting, operating leases, like you're renting dorms and apartments here to go to school. The other one is going to be more like an ownership situation. On the lessee side, we call it a finance lease. On the lessors, we call it a sales type lease. And so the substance of the leases that are finance or sales type leases, these are much more like installment loans. It's much more in substance like the lessor doesn't even own this property anymore. Like, hey, guess what? Like the Linux headquarters building. The rights of ownership seems like the lessee is more the owner than the lessor. And so therefore it is more like we have bought this. It's a finance lease, meaning we're going to have an asset on our books and we're going to have a liability on our books that incurs interest. And so the calculation is going to be a little bit different for finance lease versus an operating lease. Now on the lessor side, we have two types of sales type leases. One, because we're in a sales type lease, from the lessor side, we're going to assume we've sold this property. It's coming off of our books. Even though we still own the property, we're going to credit that asset. We're going to take it off of our books. We're going to credit equipment, credit property. It's going to leave our books because really we don't, in substance, own it anymore from a business standpoint, even though we may have legal ownership. And so the accountings will reflect the substance of the transaction. By the way, which it has not prior to 2019. So now if we sell it with a selling property, the only difference between these two is that if we sell it with a selling profit, we're going to record revenue and cost of goods sold. That's the one piece. Here, we're just going to take the equipment off of our books. There are a lot of companies that all they do is they're leasing companies. So they're not in a game of buying stuff, selling, or making stuff cheap and selling it at a higher price. There's not revenues and cost of goods sold. Their whole business model, this is banks, financial services, their whole business model is around interest, not about buying. Now, companies that sell the selling profit, maybe they have to do leases with their customers because they have high-priced goods that require, customers just can't afford to buy it if they didn't lease it. And so there are some advantages for the seller, the lessor, to have it record and have a lease with the selling profit. So here are the 5 criteria. Again, keep in mind the big picture. We're trying to decide whether this lease is going to be a finance or sales type lease or an operating lease. And with the finance and sales type lease, this is more like ownership has transferred to the lessee. And there's 5 criteria. If you meet one of these, even a single one of these, then you have met the criteria. It is going to be a finance lease or sales type. And they're the same criteria for lessees or lessors. Number 1, hey, at the end of the lease, ownership transfers. Okay, well, you never really did own it, even though you might have legal title. The ownership is going to transfer automatically into the end of the lease. That makes sense. All of these are just common sense. Or at the end of the lease, there's a bargain purchase option. I know that we had a lease with a city as a factory. We had closed down, but the city wanted to try to use it, and we gave them a cheap lease. And at the end, they said they could buy it for $1. So that's a bargain purchase option, right? And so you'll see that in a lot of lease. Now, 3 and 4, these become really important. The lease term is for the major part of the remaining economic life. So this used to read, these criteria exist in the past, it used to read 75%. Well, the FASB, a lot of people would be at 74.9. I'm not at 75. So the FASB wanted to capture this not in like in detailed increments of percentage terms. So they call it the major part. They would not even come out and say what percent that would be. The big four, the larger accounting firms, have come out and said, yes, it's still around 75%. And that's how they look at that. And so this is about the life of the thing. So if I have a asset that is 20 years, that the useful life of this asset is 20 years, and the lease is for 15, 75% of the 20 years, well, basically you do own it, because you own the major part. You are leasing the major part of that asset's life, 75%. And then, therefore, you meet that, and again, meet just one of these terms, now it's in substance truly like a sell. And so you have a finance lease and a self-type lease. And the fourth one, and people confuse these two, but this is around substantially all, if the lease payments equal or exceeds substantially all of the fair market value. So substantially all is around 90%. And so this is different. The major part, 75%, substantially all, 90% or above. So if we're leasing an asset, hell, I'll use a Lennox example. Let's say the fair market value of that building was 40 million, and the net present value of the lease payments is 36 million. Therefore, oh God, we basically bought the building with those lease payments, right? And so if the lease payments, and we're going to have to discount these back, so back to time value money, to calculate that present value, we're going to compare it to the fair value, and if it's 90% or above, we are in finance lease and sales type lease territory. And then finally, number 5, if the asset is so unique that nobody else can use it. So these are going to be unusual assets. I think about Flowserve here in the Dallas area. They make really large kind of flow pumps and different things for the oil industry. Some of these things sell for 30 and 40 million, but they're designed to go right in to a refinery or whatever, designed for a specific customer in such a way. Nobody else could use that. It's designed and built for a particular customer, maybe in Saudi Arabia or around the world. Therefore, those assets couldn't be used by somebody else. So basically, the customer owns it because you could never sell it to anybody else. Couldn't even be used by someone else. And so those are the 5 criteria. Guess what? I'm sorry, you got to memorize these. And you'll memorize them for exam 1, for the final exam, for the CP exam. You will be tested on these ad nauseum. And we had similar kind of criteria back when we just had capital leases in the past. So here's an example. I'll let you read that. I'll give you a minute. Hopefully you can see that in the video. I'll let you read that. And let's look at this. Well, I can look at this right off the bat and tell you it's going to be a finance lease because I stop right there. The 6-year lease term ending 12/31/20 is equal to the estimated useful life. So we're leasing it for the entire life. Only need to meet one criteria, so it's kind of over. But we'll come back and look at this. Here's the present value of those lease payments, $479, and that is $479, 100% of the fair value. So yes, 6-year lease term, 100% of the life. So definitely over the major part, definitely over. In this case, we met 2 criteria. We only need to meet 1. And so for each lease, you will look at each of these criteria, and if even one exists, you are in finance lease or sales type lease situation. All right, again, read this problem. It looks like a similar problem. So the same kind of term, there's 6 annual payments, 100,000, and so the present value of those is 479, and so we're going to take that number, the present value of those future lease payments, and we're going to call that a right of use asset. And so we're going to debit a right of use asset and credit a lease obligation for that 479. And we'll show you the journal entries in a minute. But one of the things we got to think about, okay, this present value really matters, not only for the criteria, do we meet substantially all of the fair market value? That's one point. But the second point, we need that discount rate because now we've got to do and put that lease obligation and that right of use asset on our books. What interest rate do we use? Well, if you know the lessor's implicit rate, you would use that. So if the implicit rate in there, and that's the lessor's implicit rate, if you know that, you are required to use that. Guess what? Hard to know. Mostly you don't know it. And so what you have to do if you don't know that is use your own company's incremental borrowing rate. How do we know that? Go down to the treasurer's office and I say, hey, Mr. Treasurer, Ms. Treasurer, hey, we want to, and I'll know around, we got $1 million asset here. If you had to go borrow $1 million today, how would you borrow it and what interest rate would be on that? And treasurers are pretty sharp about that. You'd be amazed. And I say, well, unfortunately, I say, oh, that's great. Can you write a white paper on that? Because I have to document that in my files and show it to my auditors. So when you're coming up with the incremental borrowing rate, you're going to have documentation for that. And the treasurers they become really good at it because they know, good treasurers, they understand the accounting and how this works. So here's that first entry that you will have to know: debit right of use asset, credit lease payable. And what is that? That's at the fair value, the present value of those future lease payments. Ordinary annuity or annuity due? Guess what? Annuity due, because rents are paid at the beginning. The problem, you'll be told that it's paid up front. But here we're back to Chapter 6, time value of money. You'll have to understand how to do the present value of an annuity due. As you might recall, you take your calculator and put it in the begin mode for this. That's one way. Or you use the present value of the annuity due table to calculate that. So you have two routes to go on this. And guess what? On that same day, because we made payments at the beginning of the period, we make a payment. So first entry is to record the right of use asset and the lease payable on the day we signed the contract, but we also we pay, if it's a monthly, this is an annual one, so we pay this when we pay the first year's rent. And so well, I'm sorry, I'll get to that in a minute. From the lessor side, I'm sorry, I didn't get to that. This is going to be a very realistic lecture because I screw up in class too, and I'm going to screw up on the online classes. So we haven't got to that first payment yet. This is the lessor side. The lessor is going to debit the lease receivable and they're going to get rid of the equipment. It's a sales type lease. We have the lease payments represent, in this case, substantial all 100% of the fair market value. They still have the legal title, but they really in substance don't own. They're not owners in any substantive way whatsoever. All the risk of loss, everything sitting with the lessee. And so we just take the equipment off the books, debit lease receivable, credit the equipment, because this was at the cost of the equipment. So this was not there was no profit on selling this equipment in this lease. We'll get to that later. So there's the first entry by both the lessee and the lessor. And now, here's that first payment. That's what I was talking about before. So the first payment, the lessee is going to credit cash because they paid it, and they're just going to reduce the lease payable. The lessor is going to receive cash, and they're going to credit the lease receivable. So guess what? We're going to set up a lease payable and a lease receivable, and then we'll just immediately pull $100,000 out of that, whatever that first payment is. So these two entries should be easy for you to understand. Now, The second payment, a little more difficult, because now, like that installment note from the last chapter, chapter 14, a piece of this payment is going to go to interest, and a piece is going to decrease the loan balance. So this is exactly like an installment note. And by the way, this lease in substance is an installment note. This is the same type of thing. So here we go. Interest, this was annual payments. So we use the full interest rate. We don't have to divide by 2 or anything else. This is annual payments. So we use a full 10% times 479 became 379 because we paid 100,000 on that first payment. So we got 379 times 10% interest expense, and we'll debit interest expense for this, 37,908. But we paid more than the interest, 100,000. So we take the remainder and we reduce the lease payable balance. And so now the lease payable balance goes from 379 minus 62,000 to 316. And we do this again and again, all the way down until we get to 0 on the lease payable amount. Again, this is exactly like the installment note that we saw in the last chapter. So in the second lease payment, as we just calculated in an amortization table, 37,908 interest expense, $62,000 reduction in the lease payables. And when we reduce a liability, we debit that liability. So we're going to debit that liability for $62,908, debit interest expense, credit cash. Guess what? Here, the lessor is using the same rate. They're going to debit cash, credit lease receivable, credit interest revenue. Just a mirror image of what the lessee is doing. And in any exam I give you, I believe you'll have both the same interest rate for the lessor and the lessee, so that'll make that easy. And here's the last entry. Because we set up an asset, right of use asset for 479, guess what? We're going to have to depreciate that asset. We don't call it depreciation, we call it amortization. Same thing. In all the examples I think we'll use, I won't give you double declining, straight line. And so we're just going to take 479 divided by 6 years. And so for every year, 479 divided by 6, 79,847. Debit, amortization expense, credit the right of use asset. So the right of use asset will come down to 0 over the lease term. And then finally here in the sales type lease, we'll look at it with a selling profit, and we'll record revenues and cost of goods sold. So we'll look at some problems like this. So if the fair value of the asset exceeds the cost, then we'll record. Instead of just crediting equipment like we did, we'll credit equipment, but we'll debit cost of goods sold, and then we'll credit revenues that equates to the fair value. All the other entries will stay the same. Here's an example. Let's take a look at this example. I'll let you read this. So this is pretty much the same example as before. The present value is still 479, but guess what? The equipment is on their books at 300,000. In the last example, the equipment was on their books at 479. They bought it for 479, and the fair market value of their lease payments was 479. Here, fair market value of the lease payments is 479, but they have a profit. They manufactured this equipment for only 300,000. So the entry is going to change. Not for the lessee. The lessee, they could care less whether you made a profit or not. That entry doesn't change. Only the lessor. So now we're going to debit the lease receivable, credit revenues, debit cost of goods sold, credit equipment. So we're going to record, and then when we get to the income statement, we'll have 479 in revenues, 300,000 in cost of goods sold, or a gross profit of 179. So if the fair market value of these lease payments is greater than the value of the equipment on the books, now you've got a sales type lease for the lessor with a selling profit. This, I want you to be able to know. I'll never use the easier one if I haven't completely finished the exam yet, but I guarantee you'll see problems like this on the exam. Sales type lease, guess what? No change in the remaining journal entries. They're all the same as they were without a selling profit. So here's that first entry, and all the other entries will be exactly the same. It's only that first entry where we take the equipment off the books and we record revenue and have a gross profit margin. That's the only thing that changes with a sales type lease with a selling profit. So again, this is nothing more than like an installment sell or selling something on account. And so when we went through those 5 criteria, whether this is a operating lease or finance sales type lease, that was part of the judgment we're making, that this is really much more of a sell on account. And so I'm going to stop the lecture here, and then we'll get into operating leases with the next lecture.